Our property casualty (PC) insurance business has been the engine propelling Berkshire's growth since 1967, the year we acquired National Indemnity and its sister company, National Fire and Marine, for $8.6 million. Today, National Indemnity is the largest PC company in the world as measured by net worth. Insurance is a business of promises, and Berkshire's ability to honor its commitments is unmatched. One reason we were attracted to the PC business was the industry's business model. PC insurers receive premiums up front and pay claims later. In extreme cases, such as claims arising from exposure to asbestos or severe workplace accidents, payments can stretch over many decades. This collect now, pay later model leaves PC companies holding large sums, money we call float, that will eventually go to others. Meanwhile, insurers get to invest this float for their own benefit. Though individual policies and claims come and go, the amount of float an insurer holds usually remains fairly stable in relation to premium volume. Consequently, as our business grows, so does our float. We may in time experience a decline in float. If so, the decline will be very gradual, at the outside no more than 3% in any year. The nature of our insurance contracts is such that we can never be subject to immediate or near-term demands for sums that are of significance to our cash resources. That structure is by design and is a key component in the unequaled financial strength of our insurance companies. That strength will never be compromised. If our premiums exceed the total of our expenses and eventual losses, our insurance operation registers an underwriting profit that adds to the investment income the float produces. When such a profit is earned, we enjoy the use of free money, and better yet, get Pi D for holding it. For the PC industry as a whole, the financial value of float is now far less than it was for many years. That's because the standard investment strategy for almost all PC companies is heavily and properly skewed toward high-grade bonds. Changes in interest rates, therefore, matter enormously to these companies, and during the last decade, the bond market has offered pathetically low rates. Consequently, insurers suffered, as year by year they were forced, by maturities or issuer call provisions, to recycle their old investment portfolios into new holdings, providing much lower yields. Where once these insurers could safely earn 5 cents or 6 cents on each dollar of float, they now take in only 2 cents or 3 cents. Some insurers may try to mitigate their loss of revenue by buying lower quality bonds or non-liquid alternative investments promising higher yields. But those are dangerous games and activities that most institutions are ill-equipped to play. Berkshire's situation is more favorable than that of insurers in general. Most important, our unrivaled mountain of capital, abundance of cash, and a huge and diverse stream of non-insurance earnings allow us far more investment flexibility than is generally available to other companies in the industry. The many choices open to us are always advantageous, and sometimes have presented us with major opportunities. Our PC companies have meanwhile had an excellent underwriting record. Berkshire has now operated at an underwriting profit for 18 of the last 20 years, the exceptions being 2017 and 2022. In 2017, our pre-tax loss was a whopping $3.2 billion. In 2022, the loss was minimal. For the entire 20-year span, our pre-tax gain totaled $29.2 billion. That record is no accident. Disciplined risk evaluation is the daily focus of our insurance managers, who know that the rewards of float can be drowned by poor underwriting results. All insurers give that message lip service. At Berkshire, it is a religion, Old Testament style. As I have repeatedly done in the past, I will emphasize now that happy outcomes in insurance are far from a sure thing. Danger always lurks. Mistakes in assessing insurance risks can be huge and can take many years, even decades, to surface and ripen. Think asbestos. A major catastrophe that will dwarf Hurricanes Katrina and Ian will occur. Perhaps tomorrow, perhaps many decades from now. The big one may come from a traditional source, such as wind or earthquake, or it may be a total surprise involving, say, a cyber attack having disastrous consequences beyond anything insurers now contemplate. When such a mega catastrophe strikes, Berkshire will get its share of the losses, and they will be big, very big. Unlike many other insurers, however, handling the loss will not come close to straining our resources, and we will be eager to add to our business the next day.